And now I would like to welcome our first presenter, Jason Schenker. Mr. Schenker is presenting on navigating uncertainty. He is a futurist, economist, and author who prepares leaders for the future. He advises executives, corporate boards, and industry groups. Mr. Schenker is the author of 36 books and the creator of 45 online courses on emerging technologies, finance, and the economy. Around 1 million learners have taken his courses. As the president of Prestige Economics, Bloomberg News has ranked him the #1 forecaster in the world in 26 categories since 2011. As chairman of the Futurist Institute, Mr. Schenker trains analysts, consultants, executives, and other leaders to become a futurist. The Futurist Institute offers courses in 6 learning tracks for the FLTA professional designation, including a tax and accounting professional track. Mr. Schenker has also created 20 LinkedIn learning courses focused on audit, risk management, finance, economics, and leadership. You can find more information about Mr. Schenker on the event home link page for biographies. Jason, thank you for joining us today.
Thank you so much, Robin. Thank you, everyone, for being here today. I'm going to be talking about, as you've heard, navigating the economic, financial, and AI outlook in a time of uncertainty. I know that there are a lot of different things that are getting headlines right now that you might be thinking about, have questions about, and where are we going? And that is the focus of this talk. And I want to start off by talking about really the economy and the upside and downside risks. I don't want to bury the lead here, but the upside risks, there's quite a few. And in the U.S. economy, we're in a much better spot than many other economies globally. The U.S. labor market is strong. That's really number one. I'm going to talk about the job market. I'm going to talk about the war on talent. All of that, everything that's going on in the U.S. right now really stems from that. I know there's a lot of chatter about, well, what about those Taylor Swift concerts? Are those really boosting the economy? Well, apparently in Philadelphia they are. But for the rest of the economy, it's really about millions of open jobs, a very low unemployment rate, and a very low number of jobless claims. Fed policy rates, they're near peak levels right now. We're likely to see another Fed rate hike, maybe even 2, but we're almost done to the rate hike cycle, we expect. And that's because total CPI has eased significantly. It did go up in July. I'll talk about why we still think there could be 1 or even 2 more rate hikes coming in the months ahead. Scavenger hunt economics, those dynamics have eased. So what do I mean by that? Well, in 2020, 2021, and parts of 2022, you may have been running a business, or maybe you had a client and they were struggling to get the equipment they needed, the components they needed, and then they get one of those things, then they need people, and then they have people, and then they need components, and around and around and around. It was an endless scavenger hunt. Some of those supply chain pressures are easing up, but there are some new supply chain pressures coming from Cold War II risks, which I'll talk about in a second. Consumer debt delinquencies are also really low. So as we think about the U.S. economy, this is the big secret. Don't tell anyone. People with jobs, more people with jobs we've ever had in the country, who are making more money than they've ever made, who owe almost no money delinquently, are out there spending, and that's why GDP is good. The downside risks are numerous, though, as well. On the global economy, there are a lot more risks. Global growth is slowing because while our interest rates have gone up a little bit, theirs have gone up a lot more. There's also some more monetary policy tightening ahead, like a little bit more from the Fed, but maybe a lot more from other central banks. And every time we see the Fed go higher in rates, that has a bigger negative impact, especially across emerging markets. Core CPI remains high. That is part of the problem. Core CPI excludes food and energy. Total CPI is everything in the basket of goods of a standard consumer. We'll look at those data in a second, but that's why the Fed also might feel a little fire under their feet to raise rates. Cold War II is ongoing. We don't see an end to this. Even just last week, an important executive office action was announced out of the White House regarding U.S. and U.S. citizen dealings with people who are from countries of concern. That includes China, Hong Kong, Macau. And I'll talk about what those implications are, what areas they're focused on. And corporate profits, of course, are a bit under pressure. Why? Well, there's higher labor costs and there's higher interest rates. Those things are having an impact, does threaten corporate profits in the quarters ahead, but there's still strong growth and more people with jobs buying more stuff. By the way, that's 70% of GDP is people buying stuff. So let's start with jobs. We look at the jobs numbers. I know there's often the question, and folks have said ever since COVID, where did all the workers go? Well, the labor force is right now at a record high level of 167.1 million. There have never been this many people in the labor force as there are right now. Now, these are the people participating in the labor force. What does that mean? If you're participating in the labor force, it means you either have a job or you don't have a job and you're looking. People who aren't looking and are retired aren't part of the labor force, but that still pushes the labor force participation rate lower. Part of the reason folks feel like the labor force is smaller, they look at the labor force participation rates number, is it the young people at home who are trying to become dogfluencers with their pet? No, that's not it. It's people over 55 who retired in the wake of COVID. So we look at the labor force participation rate, that's 16-year-olds and up, everyone in the economy who's not in the military, not institutionalized. There's no upper bound limit to those ages. You look at 16 to 19, labor force participation rates up since before COVID. You look at 55 and up. So again, there's no age limit. On the top side, everyone over 55, right, that labor force participation rate is down. And some of that is generational churn as you see baby boomers aging into retirement ages. In addition to a record high labor force, there's a record high number of payrolls right now. Never been this high, 156.3 million people on payrolls. That's all really great. Unemployment, super low, 3.5%. It's hit that number a couple of times recently. We're looking at, in the last year, we've had multi-decade low levels of unemployment. 3.5% is a very low number. Still solid jobs were created in the month of July, 187,000. But if you look at the trend over the last 2 years, right, almost 2 years ago, the unemployment rate was around 5.4. The number of jobs created was between 700 and 800,000. Now the number of jobs created much lower, right? A little below 200,000, but the unemployment rate's also lower. There's a lot fewer people who are unemployed to take any new jobs you have. And we can see that in the jobless claims number, because again, if we think about that labor force participation rates over 167 million, there's only 1.7 million people collecting unemployment. That's just a little bit above 1%. So earlier I said the definition of unemployment is people who don't have a job and are looking for a job. That's a household survey conducted by the BLS, the U.S. Bureau of Labor Statistics. But this number, this 1%, this is from people actually collecting unemployment according to data from the Department of Labor. This isn't a survey. We know that only 1% of the labor force is collecting unemployment right now. Really, really low levels. The record level was set below 1 million back in 1969. And right, this is, by the way, that this is pre-Woodstock levels of jobless claims, right? So that's really low. It's been a long time, right? We look at, say, the initial jobless claims, right? 248,000, almost 250,000 people lost their jobs in the past week and filed for unemployment. The record low is 162,000. But the really interesting thing here is the million and the 162,000 on a labor force adjusted basis now is smaller, because the labor force has more than doubled in size since 1968, 1969. It's about 110% larger. So if we think, what would today's equivalent be on a labor force adjusted basis to be the same and be a lot closer to 2 million, we're well below that to be at that record all-time low. And a similar thing for initial jobless claims. You'd have to be over 320, you have to be 324,000. We're way below that. So on a labor force adjusted basis, we have some of the absolutely lowest number of people collecting unemployment in history. Job openings are also really high. So while we've seen the unemployment rate go down, and that's gotten tighter, and payrolls have slowed, but they're still solid, there's also a lot of open jobs. This is JOLTS data from the month of June. What you see here is there's about 9.6 million open jobs in June. How much is that? Well, this graph, and these graphs all come from FRED, Federal Reserve Economic Database. The gray bars represent recessions. What you see in this graph is that you see the Great Recession in the middle, the '01 recession on the left, the COVID recession on the right. And what you see from this is it's gone down recently, right? From over 12 million to 9.6. But it's about 2.6 million more open jobs than before COVID. And by the way, if we look back at that '07 to '09 Great Recession in the middle, it was about 4.5 million open jobs before that recession. We're at double that. We look at before the '01 recession, it was right around 5 million. Again, almost double that now. So we have a lot of open jobs, even though it's come down, right, from over 12 million. We're still 2.6 million more open jobs before COVID. And before COVID, the labor market was tight. This is a wildly tight labor market. So there are a few impacts of that, right? If we look across sectors, this is going on everywhere. Even manufacturing, right? There had been over 1 million open manufacturing jobs about 18 months ago. But today there's a little under 600,000, which is almost 200,000 more open manufacturing jobs than before COVID. We look back to, say, the Great Recession, there were only about 300,000 open jobs before that recession. We're about double that level. Over on the left, you see the '01 recession. It was between 400 and 450,000 open jobs, a lot more than that as well. So we have a lot of open jobs. And if you're thinking, well, the interest rates would slow the job market, well, that's true. But before people lose their jobs, companies still need to burn off the backlog from the scavenger hunt economics where they couldn't find the people they needed. But this is a big backlog of open jobs, right? During the Great Recession, '07, '09, then we went from about 4.5 million open jobs to a little above 2 million open jobs, right? That drop is about the same size as the number of jobs open that we have more than we did before COVID. So even though we were to see things slide forward, which we do think things are going to slow, there's still a lot of open jobs. What's important for accounting and audit professionals, we look financial activities jobs. Were there more open jobs last year? Yeah, in June 2022, there were 635,000 open jobs. Today, there's 436,000. That is still a lot of open jobs. We look at professional business services, think about consulting, right? Which I know some of you are involved in. Almost 2.2 million open jobs last year, still 1.7 million open this year. This is a lot of open jobs. The other interesting thing here, we've seen things like tech has gotten a lot of headlines, but you look information aligned right above financial activities, still a lot of open jobs. Last year, 220,000, this year over 180. So still a lot of open jobs in tech. Construction, even though interest rates have gone up and usually housing slows a lot and construction slows a lot, what we see in the payrolls is a lot of companies are still hiring construction workers. Why? Scavenger hunt economics. They couldn't get the people they needed when the job market was even tighter, and now they're beginning to still hire. Still a lot of open jobs. Last year, 383,000. This year, 374,000. And if you wonder why some things in the government seem to maybe be a little slower than in the past, or if you're in the government, why you feel like you have a big overburdened amount of work, it's because while total payrolls are at a record, government payrolls have not recovered to pre-COVID levels. We look at the number of open government jobs last year, 967,000. This year, over 1.1 million. So the number of open government jobs has actually gone up over the past year. And we know that the employment rolls have not caught up to where they were before COVID. So a lot of open jobs, lots of opportunity. That's driving up wages. In just a little over 3 years, wages have gone up $5.19 an hour since February of 2020. This is mind-blowing to me. I like to think I'm young-ish. I'm 46. I remember working for $4.25 an hour. So to think that wages went up $5.19 in just 3 years is wild to consider. By the way, even when the economy slows, it still goes up. For example, you look on the left, the Great Recession, you see wages continue to rise even during that period. So these are not going back down. They're going to continue to rise. Layoffs have also eased up. This data from layoffs.fyi. You can see the peak number of layoffs here, the number of employees laid off on the left axis in red, the company layoffs announcements in blue on the right axis. Peaked in Q1 this year. Q2 was lower than lower than anything since Q2 22 last year, right? So this really looks like layoff announcements in the tech sector. Peaked in Q1, really high in Q4, Q2 much lower, Q3 so far quite modest. So not as many layoffs there being announced. It's a good sign. A couple other work dynamics I want to point out. This graph from Charter, based on data from LinkedIn and the Washington Post. A couple of things. The demand for remote work is still there. I know that there are some employers who really eschew remote work. They don't want to do it. I'm a huge proponent. Part of that is because I've been remote for 14 years in my own business. And before that, I worked at McKinsey, where my laptop was my office. Most consultants have, if those of you in consulting, many of you in audit, right, your laptop is your entire office for the most part. You may never even go into a physical office. And yet people rely on consultants and auditors to tell them how they're doing and how to improve their businesses. And yet when companies are faced with this challenge, we could never go remote, that doesn't work. If it works for consulting firms and auditors, it probably works for everyone. So just something to be thinking about. The other thing to consider here as well is that the demand for remote jobs is much higher than the number of postings. LinkedIn data show that about 50% right now of job applications are for remote jobs, while only 15% of the postings offer remote work. Google search numbers are up near record levels for remote work. Huge demand for remote work. This means if you're an employer fighting a war for talent, which all the previous data shows every employer is currently fighting a war for talent. The competition is fierce because there's a lot more jobs than people. Also, some recent state-by-state data released by Visual Capital shows where the jobs are, where the jobs aren't. And you can see there are some states, especially in the Midwest and the South, Southeast, where, you know, there's like 50 or 55 people for every 100 open jobs. So there's a lot of open jobs for folks. And so really remote work is a huge lever of recruitment and retention, which right now, especially in the current labor environment, is really critical. I would also point out some related work data released by Challenger Gray Christmas is if you're willing to move. This data published by Bloomberg shows that the share of job seekers willing to relocate for new positions was at a record low in the first quarter of this year. People just are not willing to relocate. Some of that is because the homes they're in, maybe they have a mortgage and they got a super low rate and they don't want to sell the house at a loss and then have to get something else at a higher rate, right? There's some of that going on, but the other piece is the remote work stuff, right? So folks don't want to move for jobs. This is definitely going to continue. I know there's a pushback. Folks are, some leaders across businesses are trying to get employees to come back to the office. They're forcing workers back into the office. That's the verbiage some of them are using. That really, I think, underscores how much workers don't want to do that. And productivity, there's a question, right? Is there better or less productivity if you are working remote? And most recently, the CEO of Amazon said everybody's got to come back to the office. And when asked about it, why are you doing this? He said, well, there's no data to it, but we believe this, that people are more productive in the office. So there's folks who have a belief around this, but the data, it's kind of mixed. It really depends what you do. But for a lot of service jobs, and if you really need to tap a bigger labor market, this is remote work is here to stay. What percent of the workforce remains remote? It's really probably going to depend how tight the labor force is. But employers are probably going to see a huge benefit from reducing their office expenses by allowing people to remain remote. And the last thing I want to talk about is some differences of unemployment by education income level. I know this audience here very invested in professional education, professional development, right? You're here getting CPE and all of that. So if we look at the earnings and the unemployment rates, I'm sure I'm preaching to the choir on this one, but I always love to share the data. We have the blue and green are the 2021 numbers. The yellow I've updated with the 2022 numbers, and you can see it. These are the 2022 averages. You can see the unemployment rate went down significantly on average from 2021 to 2022, from 4.7 to 3.6%. And you look at how tight some of the 22 unemployment rates are for higher levels of education, right? Bachelor's degrees, 2.2%. And actually, the most recent month, it's even lower, right? This is a 2022 average. It's 2% the most recent month. Master's degree, 1.9, professional degree, 1.4, doctoral degrees, 1%. Wages going up across the board. So more education, there's going to continue to be a really tight war for talent for the upper echelons of education, bachelor's degree and higher. A lot of competition there, but the unemployment rate's also really low now for associate's degrees, right? Last year was only 2.7%, even some college, 3.5. Very low unemployment rates, really positive things to see for the economy. Again, 70% of US GDP is people buying stuff. Now, the downside of what's going on, inflation is one of those big problems. We saw US CPI bounce up to 3.2%, the July report, core CPI at 4.7. Two things I want to point out about this chart. The first is the core, the maroonish, purplish line here goes from about 5.9% to 4.7 now over the past year. It's a very modest decline. It's not a big decline. Core inflation tends to be what the Fed watches a little more closely, right? That's their preferred measure of inflation. It's not going down a lot. They love to see it at 2%, right? Headline inflation has gone, last June, it was 9.1%. So it fell from 9.1 to 3% in this June over a 12-month window. That's a huge drop off, but it went up a little bit in July. So what's going on? And by the way, if we look at this, between April and June, there was a 2 percentage point drop in the CPI inflation rate. And if we look since February, there's been a 3% drop. So why, in just 4 or 5 months, did the inflation rate drop 3 percentage points? It's a lot. What's going on? And before I move on, I just want to point out, where's the Fed's 2% target? It's down here. It doesn't fit on the graph. So why did it fall so quickly? In the first half of last year, this is a base effect. These are the month-on-month increases in CPI inflation in 2022. There are some big months here. To put this in perspective, if we look at the last business cycle, from the Great Recession until COVID, the average inflation rate was 1.8%. So if we look here, we're more than half that in a couple of months here, just in the first half of last year. We get a whole year's inflation in 2 months. So what did the first half of this year look like, right? The first half of this year was much lower. So you end up with, last year prices went up a lot more. And it's not that prices went down. It's just, this year they only went up a little. So the year-on-year rate goes down. That's why the year-on-year rate's gone down, not because prices are falling now. There's no falling months here. In the first half of 2023, there were no months where CPI month-on-month was negative. None. What happened is the increases were less than the increases last year, and that's how the year-on-year rate went down. Okay, so what's the second half of the year look like? Okay, the second half of this year, in July, it was 0.0. Instead, we had an increase in this July, and that resulted in CPI going up to 3.2%. What about August? August was only 0.2. What about this August? Do we think it's up 0.2? Could be up more than that. Why? Well, oil prices have gone up more than $15 a barrel in just the last 5.5, 6 weeks. That wasn't really priced in at all into the July CPI report. I believe energy prices went up 1/10 in the month of July. That means these oil price increases and associated fuel price increases were not priced in. And that means we'll see them in August. Well, what does that mean for August? Well, we could see this be 0.3 or 0.4 month on month or more. We're expecting we could see total CPI go up to 3.4%. We were at 3, now we're at 3.2, now we're at 3.4. Now we do think core CPI is going to ease a little, probably be down around 4.4%. So core begins moving in the right way. The total CPI is going up, and the higher oil price piece, it just begins to look like the trend isn't moving the right way. In fact, because the month-on-month increases were so low last year, look at November, look at December, we think it's possible we could be between 3.5% and 4% by the end of the year, even if the Fed does another rate hike. So that means they will have a very strong incentive to do at least one more rate hike this fall, and maybe even consider one in the first half of next year. Let's talk about these interest rates. Right now, the upper bound for the Fed is at 5.5%. It's gone up at a very fast clip. It's very high interest rate increases. Balance sheet is also running down, right? The Fed is not done doing this. If we look, the balance sheet, this is money the Fed pulled out of the ether to keep the economy going. And make no mistake, during COVID, the wheels did almost fall off. I think we saw that. That's why we had so much government stimulus and so much monetary policy stimulus. with bipartisan support on the fiscal side and nonpartisan support on the central bank side. What happened? Fed expanded its balance sheet, bought all kinds of debt. As we've seen these interest rates go up and treasury rates go up, we had a banking crisis earlier this year where banks were marking to market their treasury rates, right? Treasuries, when the interest rate goes up, which has been happening this year, the price goes down. You have a bunch on your balance sheet, your balance sheet doesn't look as good. We saw this particularly happen with, the several banks, Silicon Valley Bank, Signature, Silvergate, all those had treasury problems. The result of what the Fed did was essentially came out and said, we'll mark to market what you got for treasuries. And so some banks sold their treasuries back to the Fed, making them re-expand their balance sheet. You can see the uptick on the right. The balance sheet's going down and pops up again, and now it's going back down. It's very tough to make the balance sheet go down. The European Central Bank tried it between 2012 and 2014, and then had negative deposit rates for close to a decade to recover from that and re-expanded their balance sheet. For the Fed, they reduced their balance sheet between mid-2018 and late 2019. And before COVID, they were re-expanding the balance sheet. You can see it here. In late 2019, early 2020, they're expanding the balance sheet. They weren't expecting COVID. What they were expecting was the economy would slow significantly from the reduction in their balance sheet, which means the Fed, during the expansion of the balance sheet, they bought lots of treasuries, they bought lots of mortgage-backed securities, and then they allowed some of them to mature, turn back into money, and the money to go back into the ether. But that means the biggest buyer in those markets was no longer needing to continue the principal going, to continue the balance and buying they were doing. The impact of that was slowing growth. We see now they're reducing it again. We're down to 8.2 trillion from about 9 trillion, but it's still really high. Put this in perspective, before the Great Recession, it was below 1 trillion. 10-year treasuries are relatively high right now, 4.09% as of the 10th of August. They've gone up quite a lot. They're up higher from where they were last year. U.S. credit downgrade doesn't help this story. And of course, the U.S. does have a lot of debt. And that's something I'll talk about in a second. Triple C and lower debt, this is the distressed debt in the U.S. The rates are lower than they were last year. And that does reflect confidence in the economy, but they're still very high. We're looking at an average triple C and lower debt yield around 13.5%. Triple C and lower is distressed. About half of those credits will default. Double B emerging market debt, just to show you there's also some really dicey dynamics going on in emerging markets. Currently yield 8.3%. Compare this to where we were before COVID, where it was 6.5. These interest rates are a lot higher. They are lower than they were at times late last year, but still elevated, putting a lot of pressure on emerging markets. The corporate bond distress index put up by the New York Fed, recently released, also shows the distress across categories. This actually shows that right now, relatively, the investment grade level of distress is pretty high. That's the line in red. The sluice is also no longer loose. The Senior Loan Officer Survey, which is conducted by the Federal Reserve, is a way to measure tightening loan standards. In the most recent survey, over 50% of domestic banks reported, a net 50% plus, reported tightening standards for commercial and industrial loans to large and middle market firms. It's just a little below 50% for small commercial and industrial firms, or for small firms that are taking on commercial and industrial loans. But you're seeing credit tightness that's really high. You can see that here. This is at levels that are typically consistent with recessions. So is there slowing growth ahead? Well, we think in emerging markets and globally there is. We get this data from the IMF. We look at global GDP, last year 3.5%, this year expected to be 3%, next year 3%. 3% is break even. That's kind of what you get just by global population. You get 3% GDP, but it's a real mixed bag. US expected to be 1.8%. Germany this year expected to contract. Other European economies expected to be quite weak. The UK only 0.4%, but next year expected to be better in some advanced economies like Europe, where it's very weak this year, but weaker in the US, where this year's a little bit better. Emerging market growth, pretty flat, 4% last year, 4% this year, 4.1 next year. I'd say there's even some downside risk to those numbers this year based on the potential that Chinese growth could underperform. Low-income developing economies are also slower this year than last year, 4.5% this year versus 5% last year, expected to improve next year. But that really will depend on the interest rate situation. If interest rates remain high to kill inflation, which as we saw, right, it could be higher than we are now. Now, don't get me wrong. I do expect CPI will be lower next year. And I expect core CPI will be lower next year and the year after. But I do not the next time I forecast total CPI at or below 2%, headline number is in Q2 next year. Core CPI at or below 2% in Q2 of 2025. So it might be a little while, and the Fed may be reticent to cut rates if those numbers are not at their 2% target. And part of that really just has to do with the credit situation where we've got, according to the debt clock numbers, $32.7 trillion in national debt. And according to the most recent Q1 numbers, about $31.7 trillion. Major manufacturing data is also slowed globally, indicating we've got that slowing economic activity, but we're coming off record highs. These numbers, the blue is the United States, the green is the European Union or the Eurozone, and the red is China. Couple things. These are leading economic indicators because manufacturing is a leading industry for the economy. It's a small percent of the US Eurozone economies. It's even a relatively small percent of the Chinese economy, but it is a leading indicator because it's interest rate sensitive, usually leads growth. US, Eurozone, China, all really strong in 2020, 2021, but beginning, especially for China, the second half of 2021, beginning to see weakness. And US and Eurozone more recently. In the past year, we've begun to see significant contractions and a trend of weakness lower. Now, for a lot of manufacturers, this isn't too terrible because they have a backlog from the scavenger hunt economics that they're still filling. So if I look at some of the other data that we look at or we produce, for example, for the material handling industry, we see that, yeah, new orders are down. Shipments are still very strong. Why are shipments, why have they been strong on trend? Well, you had a bunch of unfilled orders. You had a bunch of WIP inventory. And so your WIP inventory and your unfilled orders, finally, because new orders have slowed, you can ship the stuff out. Money that goes out the door, that turns into growth for the company, that turns into GDP. So even though we're seeing these negative growth rates in the United States is having less of an impact because those record high levels we had back in 2021, 2020. We aggregate the three series to have a break even of 50. Above means that month it's expanding. Below means it's contracting. There's three of them, 3 times 50. 150 is the aggregate break even. You can see the Great Recession on the left, the COVID recession on the rightish third, and all the way on the right's where we are now. It is contracting again, coming off record levels. Look at the aggregate number. It had never been as high as it had been in late 2020 and 2021. US GDP, real GDP and nominal GDP are both at record levels. Real GDP, which excludes inflation, record high in Q2, 2.4%, a decent growth rate. We haven't had negative quarters of GDP since Q1 and Q2 of last year. We've had positive growth since. And if we look forward right now, the Atlanta Fed GDP now, they produce an economic indicator that tells you what the quarter ahead is going to be based on currently available data for the quarter. Their numbers currently showing that Q3 GDP could be 4.1%. So I know there's this debate. Are we going to have a soft landing, a hard landing, or no landing, right? That may be the scenario right now. Still solid numbers. And again, it has everything to do with the jobs piece. People with jobs spending money. That's 70% of GDP is consumption. People have jobs, people have money. There's more jobs. And even though payrolls are slowing, that's a lot of upside. Still nothing but net, it looks like, for the labor market in the U.S. economy. Debt and credit, though, is a different story, right? Again, I've alluded to this now a couple of times. The Q1 numbers were below 32 trillion. The current numbers look like it's 32.7 trillion. A lot of government debt. This is why the Fed wants to kill inflation. Why? Because the government already currently pays about $1 trillion a year in interest payments on the debt it has. If 10-year treasuries and other interest rates are higher, there's going to be even more money going to debt service. But if the Fed kills inflation, that instills confidence, driving longer-term interest rates lower and short-term interest rates lower. It's a lot easier to refinance $32.7 trillion with a low interest rate than with a high one. Total debt also for consumers is at a record level, 17.06 trillion. Went up marginally from Q1 when it was 17.05. Most of this is 70% of this is mortgage debt, by the way. You can see that here. Record level of debt in Q2. The good news is the record low percentage of debt delinquencies was set in Q4 of last year at 2.5%. And the second lowest debt delinquency number is 2.6%, and that's been the level for the last 2 quarters. These colors represent the different levels of delinquency of debt. Severely derogatory in red, 30 days late in green. So all debt across all kinds of credit, right now, only 2.6% of the 17.06 trillion is delinquent. Put that in comparison to back in 2009, 2010, when it peaked at around 11.9%. This is a very low level of debt delinquency. So if people are current on their debts and they're making lots of money and they have jobs, that's kind of why the economy is strong right now, right? It's a fundamental story. And of course, it also makes sense intuitively because you had lower interest rates, allowed people to lock in super low mortgages, and you had a lot of fiscal stimulus, and those are really good tailwinds for the economy. Speaking of mortgages, credit quality's never looked as good as it has in the most recent cycle. Most recent quarter, 62% of the mortgages issued were the light blue color, which is 760 plus credit scores. Those are very high FICOs, 62% of those in Q2. If we look since the beginning of 2020, about 67% of all the mortgages issued were 760 plus credit scores in terms of value. So if we look at the value of the mortgages outstanding, it's to people with very high credit quality. And except for the most recent quarters, it was at some of the lowest interest rates in history. Even now, mortgage origination went up in Q2. And the reason for that is there's almost nothing to rent. Rental vacancies are the lowest since 1985 right now. So there's nothing to rent, and people in homes don't want to move or sell them because they've locked in such low interest rates that it's not worth it. So this really shows because, and this is the other demand piece here, and part of the reason we see, even though interest rates have gone up so much on a national average, home prices, right, and nationally, they're still up for the year, right? We see 1.6% is the national increase in home prices right now. Now, that's a very modest increase, but think about how much mortgage rates have gone up, right? We're knocking on 7% here. You know, think about those interest rate increase and home prices are up. What's going on? Well, here's the other big secret. People with jobs, more jobs than they've ever had, making more money than they've ever had, also want somewhere to live, and there's nothing to rent. So this is increasing the demand. It keeps inventory low across a lot of markets. Some markets are down quite a bit. I'm in Austin, Texas. Our home prices are down to like 10.5%, but they're down from very, very high levels because we had a couple of years of massive increases. Other areas like Southern Florida, for example, you look at Miami, home prices are up over or around 10%, 9-10% this year, whereas in Austin, they're over 10% down. It just depends on the market and where the demand is, but we're seeing different dynamics across the country. On average, home prices are up a little bit. That means what happens if interest rates go down a year from now, 2 years from now? What will happen to these home prices? They'll probably go up, right? Because when money gets cheaper, if the labor market remains the same or you know, within a relative band of health, you could see some more upside here. Now, there are a couple other challenges I mentioned. Cold War II is one of them, right? We see the areas, the oblasts that Russia has annexed from Ukraine, the conflict around there, the counteroffensive there. There's a grind. It is not moving too much on the maps. My expectation around this since early last year was that this would probably end up like Korea, where you have an unstoppable force, an immovable object, and at some point you have an armistice that's not a peace, and guns pointed at each other and missiles flying for forever, right? That's what goes on in Korea even today. And of course, that's only one part of Cold War II. We see the other issue, which is going on in China, where most importantly, I think recently you've had a change in the Espionage Act in China, which forced the State Department to make China a level 3 risk country. Level 3 is the category where you should reconsider travel. And the reason they gave was unlawful detainment. What's considered espionage? What is eligible for that now in China has much broader and sweeping definitions. So that means more people could be detained. That's why that risk is up. Now, the Russian war on Ukraine engendered supply chain issues. This is the New York Fed Global Supply Chain Pressure Index. Why was everyone playing scavenger hunt economics for the last couple of years? Well, look at how tight the supply chain pressure was, right? 2020, 2021, 2022. Now it's down a lot, which is fantastic, but it's been ticking back up in the next couple of months. And it could tick up further because we're seeing trade restrictions everywhere that have exploded. This data from the IMF, we had seen since 2009. This shows investment in orange, services in light blue, goods in dark blue. You can see the number of trade restrictions imposed annually worldwide, right below 500, right? We're looking here, 200-300, right? Trade restrictions imposed annually worldwide. Now we're knocking on 3,000. Huge change. And we look at the cost of fragmentation, right? We do believe there's going to be this bifurcation of supply chains, especially around high-tech dual-use technologies. We see that right now, and that's going to have an impact on potential real GDP losses, most severely for low-income countries. So we could see think back to the chart with the IMF data, the low-income developing economies, those could take a hit. And the executive order out last week focused on national security technology products in countries of concern. The technologies include semiconductors, microprocessors, quantum computing, and AI that could be used for national security or defense purposes. The countries of concern: China, Hong Kong, Macau. Artificial, obviously those are special administrative regions, Hong Kong and Macau, but countries of origin or countries of concerns have been captured. Now, I want to talk for a minute about artificial intelligence. I know this is a really big topic. I think right now, given the labor market, this is something a lot of folks have grabbed onto. It does present a massive opportunity for leverage. Few things. There's a couple different kinds of AI. There's predictive software, which is mostly formulaic. There's integrated software and hardware, and there's generative AI. We think about the integrated AI where there's software and hardware. Think about like robots in warehouses doing stuff on their own. That's hardware and software. Self-driving cars, another example. Generative AI, that's a little bit different. That's where you're taking all this data that's been processed in a very specific way, linear language models, and you're turning that into new outputs. And so for me, the litmus test, and this is where there's a tremendous opportunity for people working in professional services to do more with less. And I know we're all looking for that, especially in a hyper-tight labor market. And the litmus test for me is, have you ever described a task as standard or wording as boilerplate? If you have, this could be for you. So some tasks that I've been able to whip up in ChatGPT and do in longer demonstrations for corporate boards and some of my corporate clients include job postings, right? Just a couple seconds. You can whip up an accounting for the next auditor or accounting professional, consultant, anyone in your office, your company, or your client's company. You can whip those up in just a few seconds with a very light prompt. Sales scripts, right? I know most of you on this call probably aren't doing sales. I don't do sales, but if you're doing sales scripts, right, you can ask it, hey, what are 10 things I could say about this product? What would be 10 things a client would say as an objection? What are the ways to counter the objection? How can you make it more informal, right? You can do all that with the sales scripts. Things of really great importance prior to this audience: RFPs, LOPs, and also SOPs. We're talking about really unbelievable work it can do. It can also do entire project plans. So if you've got an RFP that you want to issue, you can just ask ChatGPT to write it. Is it perfect? No, but it's great for a first draft. Letters of proposal, same thing. Statements of procedure, right? Operating procedures, anything. Standard operating procedure documents, also really great for that. Legal docs. I'm not a lawyer. ChatGPT is not a lawyer, but before you give it to your lawyer, you probably could whip up a legal document using ChatGPT. Form letters, really great for that too. Press releases, fantastic. You can even ask it to include theoretical quotes And probably later today, I'm going to send out a press release about this AICPA talk. I'm going to put it up on my LinkedIn. The press release will be written by ChatGPT, and it will include a theoretical quote from me. So if you follow me on LinkedIn, you're going to see that later. I will have written very little of that and really just proofed it. Project plans, those are just tremendous. It can do something wildly detailed and extensive. I recently had it draft one up for me. It was 7-8 pages long. It did it in just a few seconds. And of course, it can even do emails and summarize things and the like. So that's fantastic. All of these things are great. There are a couple of caveats. The first is, as we think about it as a panacea, the labor market's tight. It's great. I think it can augment, but not like you replace many jobs. There are things that AI cannot do. For example, we think about the labor market. There's a lot of open jobs in nursing, trades, trucking, right? Those areas AI can't help you with. But augmenting a labor force that is already under stress in professional services, there's a lot there. And as I think about accounting and finance, did technology kill accounting and finance jobs? It did not. For those of you out there, Lotus 123, you may remember this. My father and grandfather were both CPAs. When Lotus 123 came out, they adopted it very quickly. Now, some of you, or maybe you knew some folks who were never going to use digital spreadsheets. They were never going to use computers, and they either very quickly came around or they very quickly went out of business. And of course, Lotus 123 wasn't the end. Microsoft Excel. I don't think there's anyone on this call. I hope there's probably not anyone on this call who would rather do it all by hand. I know I certainly wouldn't. I'm very happy to do all the finance work I do in Excel, and spreadsheets are tremendous. And that's how we need to think about ChatGPT, that kind of work leverage. Now, there are limitations and risks, right? When we think about different AI, not just ChatGPT, but it requires data. It can't do what it doesn't know, and it does not have current information, and it does not have complete information. This means there's a few problems, and it means that AI is 100% certain, but only 90% accurate. This changes the dynamic of who might work in certain roles, what qualifications you're looking for. Quality control becomes more vital. Proofreading becomes more valuable. Liberal arts education may deliver higher ROI now in business roles. Why? Because you need someone who can wordsmith the right questions. That sounds like an English major to me, right? That kind of folks might find more opportunity in businesses around this. Now, there are a few other big risks related to AI. There's operational risk, and this is really important, especially for you folks in audit thinking about this. Over-reliance proliferates errors. You need to be able to do the work without the AI. So, for example, Excel is wonderful, right? And I don't do long division on the regular, but I know how. And if I see something in Excel that's glaringly wrong, I know it. And that's kind of, I think, how it is with ChatGPT. In my opinion, you need to be able to spot something that's glaringly wrong. Like if I see 5 million divided by 1,000, I know the answer isn't 200,891, right? I need to be able to eyeball that and go, wait a minute, something doesn't look right here. Executive function and editing judgment really become critical. This ties back into where skill set might be. You want people to have more experience doing writing than you may ever have in the past. There are also larger social risks, right? There's a risk you get codified biases. There's a lot of news stories about this and posts on LinkedIn about this. It's a huge problem. Another problem is everything becomes dull. If you ask ChatGPT to write, I write articles all the time. I've asked it to write articles. Okay, write me 7 articles on this topic in 700 words. They are all dull. They're all essentially the same article. There's nothing interesting. There are no insights. It is not unique. Is everything in it relatively correct? Yeah, but it's not. It reads like an LOP, right? It reads like something that's boilerplate and standard. It doesn't read like an article that in any way entices me. But I will tell you, the structure of some of those articles have inspired the way I've written articles. So I may read them all and go, nothing here. I'm not going to use a single word, but I like the structure of Article 4. And then I might structure my article that way. So structure is great. Innovative, exciting content, not so much. And I know, I'm sure you all see the SAG-AFTRA strikes are going on right now. Some of that's related to AI. Do I think AI it would have written some of the movies that won Academy Awards recently? No. Do I think AI could write a Rambo reboot? Yep. Do I think AI could write the next 3 spinoffs of the Vampire Diaries? Yep. Why? Those are standard and boilerplate. That's why. They're formulaic. The other issue here is hallucinations in the data. So I'm surprised if you've got a presence online and you ask it, hey, like, tell me about me. I'm surprised to read I have degrees I have from universities I never went to and have done things in my career that I've never done and written books that not only have I not written, but no one's written. And then there's a risk that AI could get dumber. We've also seen some of that analysis where there was a 98% accuracy around prime numbers back in March. You ask it, is this a prime number? It knows. Now it's around 2.7%. There's also, for audit and accounting, this is really important, a risk of inputting proprietary information, computer code, legal terms, IP content, or confidential information. So you got to be really careful what you put in, because once you put it in, it's in the system, right? And this is like trying to get paprika out of the goulash. It doesn't work. Once it's in there, it's in. And so my recommendation always is be very careful about what you put in. If you're taking from it, like an LOP, don't put anything in. Just have it write the LOP for something generic, apply it to what you're doing, right? Don't put in anything specific about your clients, IP content, anything confidential. Not ask it to summarize confidential financial statements, anything like that. Nothing. Be greedy. Take from AI, take from ChatGPT, don't give to it. And I know there's a talk right now that some of the peak has passed. I think there's still going to be a lot of strength going forward. This data from Charter, we see peak AI hype locus dynamics really were swarming earlier this year. It seems like every year there's a trend. Last year was metaverse. This year it's AI. We look at May of 2023. That was the peak returning users. But the new users numbers for ChatGPT peaked back in February. It's almost a third lower now than it was then. So we've seen a big drop off in new users, but returning users still pretty high. You're going to see people using AI for everything. The last topic I want to talk about is climate change and emissions reporting. A few things about that. Pew Research data just last week showed 74% of Americans support the U.S. taking a global role on climate change. 67% prioritize renewable energy. 69% favor the U.S. taking steps to become carbon neutral by 2050. And all this leads to, well, we've had a really hot summer. Are people going to let up on sustainability and climate change? Maybe not, because the sustainability reporting is still coming, right? There's thoughts, will this rule, the SEC rule around reporting for emissions, is that going to get postponed? The vast majority of the American public still supports pushing forward on climate change, pushing forward on net zero 2050. And with a record hot summer and talk of climate change and fires in Maui and elsewhere, right? All of these things are not going away. Record high temperatures in Texas and Arizona and elsewhere in the US. I think there's still going to be a lot of focus here. We do not have a postponement on these SEC rules. And for large accelerated filers, they have to report, if this goes through, for the 2023 fiscal year on their scope 1 and scope 2 and associated intensity. So that's going to be a lot, right? And of course, scope 3 reporting required for fiscal year 2025, just around the corner. Key takeaways. U.S. growth is solid because jobs data are good. OPEX and CAPEX costs are high. Those threaten profitability. CPI inflation remains elevated, and AI presents opportunities, but also some risks. Limit the risk, be greedy, don't give it, just take from it. And face near-term economic challenges head on. As always, I'm sure I'm preaching to the choir on this one. I know y'all believe it. Focus on ROI, minimize cost. Account for sticky inflation. Be cautious with speculative investments. Prepare for a protracted Cold War II. It's not going away, folks, unfortunately. Focus on operational resilience and cash flow, and monitor ongoing regulatory changes like that SEC rule for sustainability. People are watching for something this fall, maybe October, maybe when, we don't know, but there's still a lot of pressure and support for sustainability and net zero 2050. Here's a disclaimer. I know you've all read it diligently. Everything could be wrong. And here's my contact info, and we'll open it up in just a second for some Q&A. And with that, I, again, thank you all very much for being here.
Thank you, Jason. We actually only have time for maybe one or two questions. So one of the ones, I tried to pick the ones that high likes at this point. So the first one was any risk in the record level of consumer debt and credit card debt in particular. You mentioned that debt is not delinquent and consumer spending is driving the economy, but could delinquencies be looming?
It could go higher from here with these record levels. It's very difficult to imagine it going in the other direction, especially with high interest rates, especially as we see student loans becoming due, or the moratorium on those ending. We could see delinquencies go up, but we're in a really deleveraged position right now. And even if it goes up, it's still likely to be very low, and that's good for tailwinds for the economy.